Welcome, everybody. My name is Michael Rivera. I'm the CEO of the Association for Corporate Growth Los Angeles. Welcome to the first panel of 2021. I think many of us hoped as we proceeded through last year that we would kick off this year back in person, but here we are. We've got a great panel that we've pulled together today. We'll be looking at, as I mentioned, the state of investment banking 2021. I think many jumped in the bunker in late March, early April, and we saw deal flow come to a standstill, but then roaring back in the third and then fourth quarter. And we'll see and hear a great deal of that about that today. And then what our panelists are looking for 2021 and how they're positioning their firms for the coming year. I'm going to hand things off to our moderator, Larry Braun from Sheppard Mullin. Larry, welcome back, and thank you for agreeing to helm the ship this afternoon. Let me kick things off by having you take things away now.
All right, thank you, Michael. Good afternoon, everyone. What we're going to do is first do some self-introductions, and then we're going to let a bunch of people on this panel educate us about what's going on. This is usually one of the most interesting panels we have every year, with everybody catching up on what happened in the prior year. Again, my name's Larry Braun. I'm a partner at Sheppard Mullin, which is a national law firm. I happen to specialize in private company M&A, and I have my subspecialty, which is I represent the crazy entrepreneurs who sell their businesses to people like Gretchen and others, and Channing, Brian, and Jim represent. So now I'm going to turn it over to Brian for his introduction, and he'll pass it along. Thanks, Brian.
Thank you, Larry. This is Brian Calasi. I'm a partner and managing director at Moelis & Company, based in the Los Angeles office. Hard to believe, but this is my 30th year doing investment banking. Been 7 years at Moelis, where I lead our consumer food and beverage. And prior, I was 17 years at Merrill Lynch and began my career at an investment bank called Solomon Brothers. So very pleased to be back at the ACG panel. Let me hand it to Jim Friedman at Intrepid.
Hey, thanks, Brian. Hi, everyone. I'm Jim Friedman. I'm chairman of Intrepid Investment Bankers. We're a regional investment bank based here in Los Angeles. Have about 60 bankers here in LA. Brian, I think I have you beat. I think I've been doing this about 35 years, so maybe a couple more scars than you. Happy to be on this panel. I started out founding a firm called Barrington Associates in 1982. We built that firm up, sold it to Wells Fargo Bank, and then started Intrepid in 2010. So Channing, it's yours.
Yeah, I'm Channing Hamlet. I'm a managing director at Objective Capital. We're a lower middle market investment banking firm. We've got about 15 folks on our M&A team. Our deals typically are at the lower end of the middle market, 10 to 100 million in enterprise value. We specialize in business services, consumer software, and some healthcare and life science. We also have a valuation practice that has about 5 folks that does fairness opinions and purchase allocations and things like that. Happy to be here, and thanks for having me. Over to you, Gretchen.
Thanks, Channing. Hello, everybody. Thanks for dialing in. I'm Gretchen Perkins with Avance Investment Management. We are a new fund. I have joined my co-founders. The founders of our business are 3 gentlemen who spun out of Palladium and have been working together over 15 years. And we are going to be investing in two verticals, those being services, mainly because 2/3 of the economy is a service economy, at least the United States economy, and consumer, select consumer sectors. We are also in the lower middle market, targeting businesses with $5 to $25 million of EBITDA. Founder-owned businesses are our preference, and we really need a growth angle on the underlying business. So some secular trend is occurring that will enable that business organically to grow more than GDP. And then, of course, we'll execute buy and build strategies and do add-on acquisitions as well to to speed up the growth as well. But founder-owned, growth-oriented businesses in services and consumer. Thanks. And Larry, back to you.
All right, thanks. Thanks, Gretchen. Before I turn this panel loose on one another and I start peppering them with questions, with any panel you have with investment bankers, you got to have a little presentation which shows fancy slides and numbers, because most of the investment bankers can't talk without those things nearby. So I'm going to turn Jim Friedman loose on that and let him tell us what actually happened with numbers in 2020. Thanks a lot, Jim.
Sure. Can we put up some slides?
Yeah, do you have the slides to put up? Okay, can you share the screen? They're gonna come now. Yeah, you gotta get them up, okay?
Okay, so like Larry mentioned, we investment bankers need a lot of prompts. So let's talk about 2020, because I think it really puts things in an interesting context for what happened. This year was a year like no other, as I'm sure all of us can attest. So in terms of the fundamentals here, what happened in 2020? There were a total of 10,700 M&A deals done between corporates and private equity in the United States in 2020. That number of deals was down slightly, about 13% from 2019. However, look at the deal value. The deal value for 2020 was up 10% to 1.7 trillion. That means there were a lot of bigger deals that got done in 2020. And the interesting thing is that in the fourth quarter of 2020, as most of us know, the M&A business came roaring back. And so over 3,000 deals were done just in the fourth quarter alone. And the transaction value of that amount of those deals was $762 billion, up 160% from the third quarter of 2020. So you can see that in a lot of respects, 2020 kind of really ended in a tremendous fashion in the fourth quarter and salvaged the year, because I know a lot of firms are going to talk about this, but you know, we weren't too bullish on the world in the second quarter of 2020. All right, keep going down if we could. I can't see it on my slide here. In terms of acquirers of companies, this is for 2020. About half, or a little over half, of the buyers were strategic, about 54%, and 46% were private equity. That seems to be kind of pretty much in line with historical trends. So private equity was just as aggressive in 2020 as in prior years. Deal sizes, if you look at the chart on the top right, over half the deals that got done in terms of number of deals were done at under $100 million transaction values. So that's where the bulk of the deals got done. And then when you sort of throw in the under $500 million, you know, you're looking at about 80% of all the deals that get done. And then finally, if we scroll down a little on the sectors, and this is important here, because I think this is really a defining trend for what you can expect in the future here. The biggest sector for 2020 was business services. About a quarter of all deals were done in business services. It's a very hot area. It's a big, broad category, but really seems to be a very big focus. The second was technology. And technology is kind of roaring. With COVID and all, the tech companies, as you know, did great, and they've been a standout. And the third category was healthcare. So between those three, you know, you're looking at what, 60+% of the market in terms of just those three categories.
It's good now.
Then you have the others, you know, financials and consumer and commercial and manufacturing, were smaller. But look at healthcare, technology, and business services, because I think that's where you're going to see the world going, and that's where a lot of deals are being done. And then we'll go to the final slide. And this is just kind of an interesting anecdote of sort of, if we could put ourselves in a retrospect. In the beginning of 2020, when COVID just happened, the world came out with what's going to happen with M&A in COVID. And then you can see a little further down, if you can scroll up just a tad, there was I think it was Fortune magazine said that the M&A business was kind of falling off a cliff, and they felt that it was going to continue to. Well, it did fall off a cliff, but it sure came roaring back after the third quarter got much better. And then the fourth quarter, we just had record-breaking sort of results. So that's kind of where things got left here in 2020. I thought it's an interesting sort of chart. Maybe a lot of you have experienced it, but that's kind of the state of the 2020. Larry, I'll turn it back to you.
Thanks a lot, Jim. Look, a lot of things happened in 2020. Lakers won, Dodgers won. I mean, those are the important things, not, a pandemic, which still is affecting all of us, and we're all doing this from our houses. There was that little election thing that happened, followed up by that you had more elections because Georgia couldn't figure it out. Then they threw us a curveball, and then we had a little insurrection. Who knows what else can happen? But we're gonna ask Brian to do a little heavy lifting here. We're gonna give him all of 5 minutes to explain all of this to us before the panel starts badgering each other with questions. But Brian, give it your best shot.
Thanks, Larry. Well, I have the benefit that one of my partners is Eric Cantor, who served 14 years in the House of Representatives and rose to majority leader in the Republican Party. So he helped me prep for this a bit. But obviously, it's been a tremendous change of the power structure in Washington, D.C., coming from when President Trump came into power with both kind of a consolidated control of the House and the Senate. Now with the Georgia elections, the runoff that Larry just referenced, the Senate effectively being 50-50 with the tiebreaker vote going to Vice President-elect Harris. There are very thin but majorities under Democratic control, with President-elect Biden coming in next week. And the really interesting thing is that opposition to legislation can really come from any corner. It could be one senator, it could be a coalition, a bipartisan coalition of 4 or 5 congressional representatives. So I think one of the key questions as we look at how this will impact our clients from the regulatory and legislative perspective is a fewfold. Number one, how much will be, I'm sure everyone saw the news today, President Trump was impeached by the House of Representatives with 10 members of the Republican Party voting for that. So what's going to be the hangover for other elected Republicans? Do they seek to separate themselves? Do they from the president and his agenda in the months ahead? But on the flip side, how much will the Republicans in both the Senate and the House really be motivated to work on a bipartisan basis to give the new administration a legislative win here in the early days? Or will they really view that a continued obstruction is a better path to regaining their majority position in the 2022 elections? As we look at it, there's about a half dozen key legislative priorities, big themes that we think are most telling for both the deal environment and for our clients. First, probably the tax code. And I think that, from our office in Washington, D.C., there's a lot of conversation this week about does the Senate use kind of the reconciliation process that only requires a 51 vote to perhaps undo the Jobs Act or the Trump tax cuts. And what's on the target we're hearing is most likely an increase in the corporate corporate tax rate from 21%, probably not back to 35%, but maybe to a middle ground. And also the return at the highest individual tax bracket from 37 back up to the historical. We also are hearing rumblings about capital gains tax, but that's not as clear if that will happen. So that's a big one, and the belief is that very likely in the Senate they will use the reconciliation process to try and pursue that change just with the 51 votes needed. Secondly is the economic stimulus package. So everything from direct payments, the talk of changing the $600 checks to $2,000 checks for many Americans, extension of unemployment insurance, aids to states and municipalities who've had their tax revenues dramatically impacted by the pandemic, and even looking to invoke, as President-elect Biden said on the campaign trail, a federal minimum wage up to $15 per hour, which he said he would do in earliest days of his administration. So the economic stimulus is, I think, in many ways, my opinion, why the equity markets rallied after the Georgia runoff, and the belief that the spigot of free money, or at least initially a lot of capital coming out of the public sector, will keep rates and cost of capital quite low. Thirdly, infrastructure, and this is an area that has had, generally popular support, and there's a definite need for us to work across the country on our infrastructure. Immigration reform is another area that we think could be revisited. And on the cost containment for prescription drugs, that is likely to be in the crosshairs of the drug companies, and looking to use the federal purchases of the Medicare and Medicaid plans to really try and get some control over the pharmaceutical industry, which is not surprising. That's been a priority for a while, but the pharmaceutical industry, I think, truly distinguished themselves in the last 9 months with the speed of the vaccine generation. Also, energy policy, how President Biden will deal with fracking, as well as renewable energy, and certainly, on the more progressive side of his party, the Green Deal. We don't think the Green Deal likely has a lot of legs in this Congress, but good chance that the United States returns to the Paris Climate Accord, and then you have tariffs. So I don't know, Larry, if I hit it in 5 minutes, but there's a lot going on, and we think it's really thin majorities in both houses. There's hopefully going to be some bipartisan to get important work done.
Yeah, Brian, thanks a lot. I mean, that was almost Twitter-like. You did it unbelievably quickly. So thank you. And they haven't turned off your account yet. Look, we've got tax uncertainty. We've got stimulus package coming. We've got infrastructure. We've got low interest rates. This has got to be a world for private equity and the investment bankers. So we have a great panel. I'm going to start it off and start asking questions. Channing, tell us what you see going on out there. What are you experiencing in your world? What are you seeing in terms of multiples? What do you want everybody to know?
Yeah, it's an interesting question, and what a roller coaster we've been through. I think that what happened with us and a lot of our clients in March last year, we were all told that we need to stay home for a couple weeks. The virus would go away, and then we'd get back to work. And I think none of that's really happened. But I think coming into the new year, a lot of our clients, and we feel like that it's kind of here to stay, and who knows how long it's going to be here. But we're sort of back to business in the new normal. And in our firm, we saw the same trend that Jim showed, where it felt like business came to a grinding halt in March, April, and May, and then in June it felt like someone turned the lights back on and we were off to the races again. And we're positioned to have the best year. We're positioned to have the best year we've ever had. Our backlog is great. The number of inquiries we're getting in December and January for new deals is kind of at historical highs for us. I think the biggest challenge that we're facing with our clients relates to valuation. I think multiples remain, pretty robust and near near all-time highs in the 25 years I've been doing this. The challenge we see is that there have been winners and losers in COVID. And so, businesses that were, we have a direct-to-consumer e-commerce business that was very positively impacted by COVID and the shift from on-premise retail to DTC, and they're killing it. Buyers don't give them full credit for the fact that they're killing it. Then we have other companies that were impacted negatively, and buyers want to take full credit for the negative impact and give us a low valuation. And so there's a lot of discussion about what is the profitability of a company, coming out of COVID. What can we expect in this environment and the new normal? And so we've been spending a lot of time with our clients and a lot of time with buyers across all industry sectors, really figuring out, what is the profit, what is the EBITDA that we multiply by. And I think that's one of the big challenges that we're seeing right now. Aside from that, it's, from what we see, all systems go, and it looks to be a great year.
Well, Gretchen, we know you want to pay full price and really make sellers happy. Tell us what you're experiencing out there. What are you seeing from your perspective as a buyer?
Channing, I'm feeling attacked. I'm feeling attacked as a buyer. We don't want to give you credit. We only look at the bad. But you are a bit right there. It's I think what's interesting in terms of the lull we had in the market, right, early in COVID, and then the accelerating snapback, you can point that to lenders, right? Without lenders feeling comfortable and actively lending, that's what really stops our M&A market or slows it markedly, right? Because if the lenders pull back, then, valuations come down and those go together, right? That's like supply and demand. When the lenders get chilled, valuations drop. So I think lenders got comfortable that the sky wasn't falling. Their portfolios were not completely blowing up. Certainly there's some losers and some winners, but I think most private equity firms, when we were all forecasting our 13-week cash flows in March, in terms of when we're going to run out of money, PPP loans were starting to be kicked around. How much longer can that extend our liquidity? I think most private equity funds would tell you that it wasn't as bad as we forecast. The actual experience through the next 13 weeks was not as bad, right? Plus, we were all making these projections in a very dire time, right? It looked dark and it looked, it was scary. So that's good news. It wasn't as bad. And the lenders saw that too. And so they have provided, the lubrication to get deals going again, to get the deal machines going. So I think that's good. In terms of what we're seeing, I'm starting to see deals, and I saw deals in the fourth quarter as well, with EBITDA, the C being COVID adjustments. And my gut tells me, when I see that, I'm like, wait, that's assuming we're done, right? We're not out of it yet. Frankly, until we're on the other side of vaccines and people are doing normal things again, it's a little bit early, in my opinion, to quantify some, COVID adjustment, because we're not through it yet. And it's not necessarily non-recurring yet, right? It will be I'm going to be optimistic, July, but it's not right now. So there's some, to your point, Channing, there's certain things that we can clearly see from what happened in March and April for businesses that happened to be shut down, whether it was because their state, deemed them non-essential, or because they had, COVID running through the facility. When they got back up and running, let's say May and forward, you can make some of those adjustments, but some of the adjustments I'm seeing are continuing, right? So it's hard to give those full credit. I think you're right. I think some on the buyer side of the table are overly penalizing, your DTC business that's crushing it, because some of these trends of people DTC and buying buying online and not going to stores, those will continue, right? There's a whole lot of habits that are being formed now that are awesome, right? About not having to go to the mall, not having to go to the grocery store.
Sure.
And so I think some credit can be given to some of those businesses who are really benefiting from COVID simply out of consumer behavior and convenience.
Okay. Before we talk more about COVID, because it's ever present for sure, I'm going to turn to Brian and Jim, and maybe Brian, you can go first. What industries is Moelis & Co. seeing as the winners last year and continuing into this year? And then Jimmy, maybe you could do the same in the sectors that you folks cover. Brian, can you go first?
Sure. Well, at Moelis, we both do M&A advisory as well as restructurings and recapitalization. So especially in March, April, May, we became very busy in those industries requiring restructuring help. Again, we used to think about, well, what would happen to this client if EBITDA fell by 20% or 30%? Well, we had clients that had revenues falling by 80 or 90%, or in fact, negative revenues, because if you were in the hospitality industry, you were giving back deposits and prepayments. So those industries, obviously, travel, leisure, hospitality, dramatically negatively impacted. Business services and healthcare and tech, again, not surprising, and following the trends of the M&A environment, have really been gangbusters, right? Finding new ways to outsource services, either for commercial, industrial, or consumer needs, has been a big winner. And I agree with Gretchen. The COVID behaviors, I see it in my own kind of food and beverage clients, where the behaviors of people shopping online and getting either at store pickup or delivered to their home. If my 77-year-old parents are now doing their grocery shopping online, they're going to stick with it. And we've seen it a big boom for a lot of the direct to consumer and e-commerce plays.
Okay, Jimmy.
Yeah, so I guess I would agree with all the industries that Brian talked about, but I thought it'd be helpful to look at this sort of picture that we're in right now, because I find it to be very different. I was on this exact panel 4 years ago when Donald Trump got just elected, and they had this identical panel in January of whatever it was, 17.
Yeah.
And it was really crystal clear. We had this low tax rate kind of guy coming in, big business stimulus, and it was so clear that M&A was going to benefit from the administration that got in. And I think all panelists were sort of on that same path. If you go fast forward 4 years later, things are extremely different than where they were 4 years ago. So a few things to kind of think about is that interest rates are ridiculously low. We didn't have that, a while back. And so there's no place to put your money. Look at the bond market. I mean, it's terrible, 1%, 2%. People just don't want to do that. So they're all looking for alternatives to sort of put their money. And so private equity is sitting there with a catcher's mitt saying, we have an alternative to this. So you got this tremendous amount of dry powder and capital. Private equity raised $500 and some billion last year. It was a huge fundraising year for private equity. But on top of that, a really unique thing in 2020 that we'd never seen before. There were 75 SPACs that came to market in 2020. I'm sorry, 250 SPACs came to market with $75 billion raised. This is unheard of. I mean, who knew what a SPAC was 2 years ago? Now there's tons of this blank check money that's out there. You've got the stimulus that some of the folks talked about that's creating this demand for buying and for increasing the economy. You got the lenders, as Gretchen mentioned, back in the market. And you've got COVID, which people are seeing 6 months, 9 months from now as maybe being in the rearview mirror. So you got a bunch of completely different variables from 4 years ago, but they all point to the sort of same conclusion that we're all going to be pretty fat and happy, in the next few years. And that's kind of how I'm looking at the world. And as Channing mentioned, our backlog is as big as it's ever been. And I think a last thing, and then I'll shut up, is that we deal with a lot of private company owners. And I think COVID has had an impact, a psychological impact on people like we've never seen before, to the point where they've now thought about their life in a lot different ways and their mortality and have decided that, maybe I don't want to work till I'm 80 years old, and maybe there's other things that I can be doing, and life is fragile and short. So I think that's also tending to drive people. California's losing a lot of businesses going to Texas and other states, but I also think that entrepreneurs have kind of woken up and said, this COVID thing has sort of put a different perspective in my life. So a few thoughts to consider.
Well, I think you're right. I think there's going to be a lot of competition for deals out there. Channing, when you're talking to your prospective seller clients, what are you telling them about what they should look to in the future? Should they wait because it's going to be better at the end of 2021? Or is this the time to strike? What's the conversation that's driving them with all the chaos that's going on?
It's Jim's comments were super interesting. When I started in investment banking in the mid 90s, private equity firms were, private equity was a cottage industry, and they were modeling out 35 to 40% returns, which, maps back to 4.5 to 5.5 times EBITDA. And it seems like, every year that's gone by, there's been more and more money in private equity. And, now private equity firms are modeling returns half what they used to. And, multiples are at an all-time high. And so in our market, when I meet a business owner whose identity is really kind of wrapped up in their business, and they like their job and they're part of their company, it really comes down to what they want for their life and their family and their objectives. But when we meet business owners that have really built a management team and view their company, a little bit more as an investment and an asset they own, we're sort of telling them they're crazy if they're not at a minimum talking to a private equity firm and looking at taking chips off the table. I mean, with, valuations at historical highs, the private equity firm returns, sort of nearing a floor where the economic viability of private equity firms makes sense. This is a once in a lifetime opportunity potentially to take a lot of money off the table in a low cost of capital environment. And so that's kind of how we're thinking about it with our clients as it relates to private equity. And then given that private equity is so strong, that creates really strong competition for the strategics, where they really need to see a strategic need or a strategic potential to beat out a private equity firm. And so long story short, it's for businesses that were not decimated by COVID, that have stability and a positive outlook, it's as good a time as any to look at the market.
Yeah, let's put Gretchen on the spot, though. I'm sure she loves that. So Gretchen, now you've heard the other panelists. You got SPACs, you got strategics, you got family offices, you got private equity groups. Everybody and their mother are going to be buying businesses. What does the private equity community say, and how do you compete in this, and what are you seeing out there?
Well, let me just zoom back a bit and touch a bit on some of the comments Jim made, which was, 2020 was a record year for private equity fundraising. There's a reason for that. The reason for that is the private equity industry has generated higher returns than any other asset class over, name the time period, 2-year, 5-year, 10-year, 15-year, 20. And that's why even in times of great disruption, you still see lots of money pouring into private equity. They're chasing yield. And obviously, to Jim's point, based upon the alternatives, we're looking even better than ever. So these are billion-dollar pension funds and college endowments and insurance companies. They're very sophisticated investors. So why are they pouring more money into private equity, creating an even more, competitive environment? Because, our industry only makes money and only lives to see another fund with growth. And so our industry has evolved over the past, I've been in the industry for 20 years. It has really evolved in terms of the resources that the industry must bring. The operating executives, we must bring to an investment to really grow the business, right? Not just, do some add-on acquisitions and grow with GDP and, sell it at a higher multiple because you're a bigger company. You really need to know a space, know what levers to push to improve the top line and the bottom line to get the growth so that we can live to have another fund. And that, kind of survivalist nature really causes the industry to figure it out and do better. It's a very mature industry right now, right? So, we're going to compete by sector knowledge, domain knowledge. We're going to compete on timing, process, right? The investment bankers, they want to make sure their deal closes. They want to get their fee. The business owner, the more time passes, that is never good, right? Time is never good for process for anybody. So, those of us who can move more speedily will do more deals, and investment bankers will reward those who can move fast. So you got to have your ducks in a row from a market mapping research basis, as well as you're assembling your tribe of operating resources that can help you grow in that specific industry.
Great. I'm gonna move this around a little bit, and this is for the three investment bankers. And Brian, I'm gonna hit you first. And COVID's changed a lot, and we all adapted in March, and we're all continuing to adapt. Can each of you, maybe first you, Brian, and then Jim, and then Channing, give 2 examples of how it's changed how you do your business, meaning how you process deals, how you go find new business, how your shop operates. Everybody's interested in trying to pick up tips. So, give me your 2 best shots, each of you.
Well, I think, Larry, one of the biggest changes for me personally is just the efficiency of my day and week. So in 2019, I had the ignominy of being a concierge key on American, 1K on United, and Delta Platinum. So I spent a ton of time on airplanes flying all over the country, around the world. And while it was great to see clients and see them in person and make that impact, it was not the most efficient thing. And so now, working from Zoom and working on the phone, I can just be a lot more efficient reaching out and connecting. And that is, it's a headwind, let's say, in trying to build relationships, but it's a major tailwind to efficiency where you have an established relationship, someone you've known for years and years, and they don't have to have lunch with you, right? So that's the one thing I would say. And we've seen that absolutely in spades at Moelis. The levels of our productivity, our junior bankers are working super hard. They always have been, but now, they used to get a breather when, the senior guys were on the plane and there were no more changes to be made on the books, right? Now it's just continually changing and updating. So I would just share that one big, we are in a human capital business, intellectual capital business. The velocity and efficiency that we've experienced here in the last 9 months, kind of really since June, once we all figured it out, and this is the new normal, and it's a risk-on environment, as the other panelists have said, we've been just going gangbusters.
Gotcha. Jim, you want to go?
Sure. I think that Brian kind of hit on a very important topic. So I think that in the last year, I may have driven 1,000 miles in a year. And I got to tell you, I was doing that a month or more than that in a month. And it's actually kind of nice, to not be in the car all the time, traveling around and then the airplanes. And so the good news is you're not out wasting time on these just logistical stuff that don't contribute anything, then and you're becoming a lot more efficient, for sure. The issue is that I'm stuck in this stupid chair from like 10 hours, from like 7 in the morning to 7 at night. And I don't remember to eat or to go for a walk or something. And you're just stuck here. So yeah, you're definitely more efficient and doing a lot more stuff, but it's just takes a little getting used to. And then we're having, I'm sure Brian, the same thing, is having to do a lot more communication with our teams and our people, because you don't see them in person. And so we actually proactively have 2 or 3, meetings a week with different groups to just check in, see what's going on, and kind of making sure the culture and the camaraderie is still there. We actually brought on 9 new analysts this year, and they've never been to our office. So it's just an interesting sort of thing going on, but it's working. I mean, we're making it work.
Channing, maybe you can, and then Gretchen can talk about how you're processing deals differently.
Yeah,
Go ahead.
it's interesting. We closed a deal in December. A private equity firm wrote a $20 million check, having never met our client in person. And I was absolutely blown away. But as far as the process goes, when you look at sort of the traditional 2-step investment banker process that we all utilize, where there's, you send the books out and there's an initial indication of interest, and then you select a smaller group of parties to come in for management meetings. Historically, our firm has used those management meetings as an opportunity for our clients to really interview and get to know the buyers and understand what makes them tick. And most of our clients are, obviously looking to maximize price, but they're also really looking to find a good steward and the right fit for the next evolution of their business. And we've really kind of wrestled a little bit with how to create that dynamic over Zoom. And so, well, on the one hand, we've been a lot more efficient by doing, management meetings over Zoom. It's easier to knock out. More meetings, include more parties in the process, et cetera. We've found that we've wound up doing 2 and 3 and 4 calls with some of the 2 and 3 and 4 meetings over Zoom with some of the buyers that are interested, to try to replicate some of the opportunities that you can't really easily replicate in Zoom. So, well, we have gained some efficiency. It's also taking, a lot more work and thought to give our clients exposure to the human side and the culture and the chemistry, so that when they do have, that handful of best and final offers, they're really equipped to make a decision, not only on the deal terms, but on the personalities and the fit. And that's something that we've worked really hard at. And it's something that we're continuing to evolve as part of our process. I would say I agree with everything Brian and Jim said. My, car is just sitting in the driveway, rotting in the sun, and I don't miss it. I love being home and just getting my work done.
So Gretchen, what are these investment bankers doing to get your attention? And how are they showing you their clients and making sure you can make a great decision in terms of proceeding in a process?
Yeah, it's similar on the front end, right? It's a phone call, it's an email, a small overview of a transaction. You get on the phone, and you have those conversations. And because, especially in the business development role, I was traveling every week, right? And so it was harder to find the half an hour in the day where I'm going to call Jim or Brian or Channing back and say, hey, okay, let's go through these initial set of questions I have while I'm trying to pre-qualify this opportunity. So COVID has made it, super efficient. So same theme there. And, what we found is the initial management meetings are all virtual, and, you get a in-person meeting if the business owner is comfortable with that. And our experience has been they are, properly distanced and all of that. When you're down to one of the finals, right? When you're down to, maybe the final 2 or 3. And I would think business owners and bankers love that, right? That's a wonderful reduction of the amount of hours you have to spend going, because we would always want to go to dinner, right? And the night before when we come in, you want as much time with that management team as you can get. I will say you do lose something if in all of these, we like to think we're all better in person than we are over Zoom. And so you try to, show enough of yourself and our firm's culture to make sure the business owner can get to know us a bit, right? We're all getting married at the end of the day. We're going to get married for at least, 5 years, let's say. So the relationship is very important. And that is, that's been the most challenging aspect of a process now. But I think, to Brian's point, we all figured it out. We're all just operating in this world, and business owners, if they're going to market in this time, they, the bankers have properly prepped them. And what's also very helpful in this process is that the banker knows the people at the private equity firm, right? The business owner is going to be relying a lot more on their banker for advice. Like, Jim, have you dealt with Gretchen in the past? How do they behave? Do they bait and switch? Are they good guys, gals? Brian, tell me how, Avance performs in other deals that you're working on, right? That relationship we've all spent decades building really, really bears fruit in a time like this. So I would also say, along the theme of, never let a good crisis go to waste, on the fundraising side, for, when you're fundraising, you don't have a fund, you don't have any management fees yet. The ability to do all of this fundraising, all these meetings via Zoom, instead of having to get on a plane and fly somewhere, has been an excellent savings and efficiency tool for us.
So let me say what I'm hearing. Deal flows up, money is everywhere. Your teams are incredibly occupied. I assume none of this has any impact on your fees, and COVID really hasn't done that, and it's kept deal flow flowing, and people should expect to pay the same or more than they ever paid for your unbelievably great services.
I don't think we have not seen any compression on fees. In fact, in some ways, I think that just on the point Gretchen just made, which is a lot of our clients, the principals are really relying even more heavily on their advisors, their legal advisors, their financial advisors, their tax advisors. We've seen people willing to kind of pay up for more premium service. So it's been a benefit to our franchise.
And while you're answering that, Jim or Channing, what about staffing? Can you find people? Jim, you just mentioned you hired a bunch of new analysts. Brian, are you guys able to find people, and you too, Channing, when you need them?
Just quickly on that, on staffing, I am worried about, I started as an analyst, in 1991. I am worried about the gaps of what people aren't learning, sitting all together in cubes and sharing best practices and teaching models over their shoulder. But we're doing the best we can. I think everybody's eager to get back to an office environment when it's safe to do so. We have had no problem hiring people. Moelis made a decision last summer that even though our summer program for MBAs and undergrads was virtual and not able to be in the office, anybody who completed that 10-week program was guaranteed a full-time position upon graduation. So we have full staffing.
Yeah, I think we've hired a few people during the pandemic, and interviewing is really tricky for the same reasons I talked about with the management meetings, in terms of really getting to know people. In a small firm like ours that's 20 folks, onboarding is a little bit more tricky. But I think the big issue is we're missing out on a lot of the sort of chit chats by the water cooler, and hanging out in the office talking about some issue or idea that a lot of the junior people learn from, and a lot of the senior people, there are no easy decisions in M&A. So the more smart people you have looking at and talking about an issue or an opportunity, the better advice we're able to give our clients, the better ideas we come up with. And it's really difficult to replicate that, having everybody kind of spread to the wind. It's, for some reason, it's a lot easier to, get up and walk next door and talk to somebody than it is to, send them a Zoom invite and log into Zoom and hope they're available and all that stuff. And so I think we're sort of looking forward to, getting back to the office and getting back into the routine of, collaboration and teamwork the way we were doing it pre-COVID, because that's been, really tough to replicate.
Okay. I'm getting peppered with a bunch of questions here, but so let me turn to all four of you before we have to wrap it up. We've got about another 5 minutes left. 2020 is going to be a memorable year. I think we all thought we'd get to 2021 and the world would change, and it probably hasn't yet. Hopefully it will once we all start getting vaccinated. But you all got deals done. Can you each take a minute and talk about one that you got done? Obviously that's public, that was unique or fun or inspirational to you that you really think people would get something out of hearing about. Anybody want to go first?
Sure, I'll go quickly, Larry. We were
Sure.
advising a privately held, a founder-owned beverage company, and had run a process in 2019, and just didn't get the level of valuation that our CEO and founder was looking for, but had very big growth plans. So we pivoted and decided to raise some capital instead, some minority capital. And I remember having a conversation with the CEO. He's an aggressive guy, and this was in January and February, just as we were starting to hear about the virus in Wuhan and people getting sick, and I just said, Bill, take all the money that you can, right? I mean, we're not positive cash flow right now. You have big plans. You're going to spend it. Take the dilution, modest as it is, and take all the money and have a fortified balance sheet. And I'm really glad that he did that and we did that.
Yeah, just before I turn to somebody else, the last 6 months of 2020 was, my view, the minority deal year. People flipped and went to minority deals thinking, I'll get money, and next year, the year after, when everything's back to normal, I'll really cash out again. But Jim or Gretchen or Channing, who wants to go first?
We had a client we worked with in 2018, and they had one of their large customers terminate the relationship. So we had put the project on hold in Q1 2019 and had planned to revisit once the business had rebuilt. CEO called me in July last year, and most of their customers were in the travel sector. So he called me in July last year, and they were really struggling. And so we were able, and basically the company was facing Chapter 7 bankruptcy. And so we were able to bring one of the buyers that we had spoken to in the past back to the table to restructure and recapitalize the company and get it on solid footing with a new direction going forward. And so, while it wasn't like a premium deal where a bunch of people got rich, we really did help preserve that company and preserve all those jobs and get the company kind of set on solid footing going into this year. So that was pretty rewarding and fun project to work on.
Great. Gretchen?
Yeah, at my former firm in 2020, we invested in a business that was in February, I believe it was, in the laboratory equipment space.
Oh boy.
Was like, wow, that turned out to be great for reasons we did not model in.
That's right.
So long-term prospects of that portfolio company are strong.
All right, Jim, anything?
Yeah, so I guess one deal that we closed a couple months ago, it's public because we announced it, is a company called Visual Data Media Services in Burbank. And they're a fairly large post-production type company. And that's a deal that we had figured that it would be a strategic that would want this business. And to our surprise, we ended up getting a lot more private equity interest. They had historically not been too keen on this industry. And we ended up doing a deal with a private equity group, Endeavor. And one of the things that Gretchen brought up, which was important here, is that when you're dealing with private equity in this environment, the client is looking to us to say, who are these guys? And, who should I be doing business with? I happen to like Endeavor. They're a great firm and we've done business with them. And so I advocated for them, so I became kind of not just getting the high price, but who's going to be the right partner. And we're finding that we're doing a lot more of that value add as an advisor to the company than just sort of throwing the meat out there and seeing the sharks come.
Okay, great,
Shark,
thanks, Jim.
I'm feeling attacked again.
Well, now you got 3 people are going to recommend you to everybody they talk to, so you're
That's
good.
right.
You're good to go. So listen, folks, we've got to wrap up in a minute or two, so I'm going to give you each 15 seconds. They're all deal junkies on this call. What's a message to them? What do you want them to take away from just listening to all of us? Anybody want to go?
I'll go first, Larry.
Sure.
Brian, I took notes on your list of things from your partner, Eric Cantor, and all I see in that is opportunity. There's all sorts of sectors that are going to benefit from these changes. So it doesn't matter what side of the aisle you're on, you're an investor or you're a seller or you're an advisor. There's opportunity in those 7 points you laid out.
I think, Gretchen, it's very much, and the thing I would share, Larry, to the group, it's a risk-on environment. It feels in many ways similar to the mid-2000s, kind of 04 through 06, before the really heady days of 07 when leverage got wacky. But I think from those of us in the intermediary business and on the principal investing side, it's going to be a very busy and lucrative next year and a half, 2 years.
Yeah. Jim or Channing?
Yeah, I would agree that I think things are going to be very frothy in our world. I do think that it's also going to be very competitive, at least in our world, and our competitors are very good. So you still got to be on top of your game. And one of the things I'd throw out there is, learn how to be your best at Zoom, because that's a whole new skill set, and sort of practice that up, because that's how you're going to end up getting business.
Channing, anything?
I mean, I think I echo what everybody said. It just seems like there's tons of opportunity out there and a lot of positive momentum coming into 2021.
Yeah, this is going to be a race, and it's good you got a lot of young people at your shops to carry the load, because I think we're going to be all working long hours, and vacations are gone as far as I can tell, because you can't go anywhere. So
Might as well work.
we're all stuck in Jim's chair, for at least 12 hours doing it. Michael, a great panel. I'm going to turn it back over to you, and so you can put this to bed.
I appreciate that, Larry. Thanks so much for moderating. You are the master, and had obviously a great group here. Jim, Gretchen, Brian, and Channing, really appreciate on behalf of ICG Los Angeles your time. I know one of the advantages of Zoom is that we've got someone in LA, someone in San Diego, someone in Hawaii, someone in Michigan. I'll leave it up to all of the viewers to figure out who is where, but we have the ability to bring in differing perspectives and have this conversation. I think 2021, for all the reasons that we've discussed today, is going to be fascinating, opportunistic year. We hope that for those of you out there watching that you come back and join us for other webinars we may have and networking opportunities. I echo what Jim said. The Zoom skill set is one that we all need to hone and keep sharp. So again, I thank all of you for contributing today, and for our audience out there. Thank you so much for attending. Take care.
Thanks
everybody.
for having us.
Thank
Thanks.
you.
Thanks,
Bye,
guys.
everybody.
Bye.
Bye now.
Larry.
Bye-bye. Bye, Gretchen.